$208 silver. I know how that sounds. I know you probably scrolled past 3 videos today with ridiculous price targets. I know you have seen the clickbait. I know you are skeptical. Good. You should be. But here's the difference between this video and every other silver video you have watched. I am not going to give you opinions. I am not going to give you feelings. I am not going to tell you silver is going up because I hope it does. I am going to show you one chart, one ratio, one calculation. And by the end of this video, you are going to understand exactly why $280 silver is not crazy at all. In fact, you might think it is conservative. The math is the math, and the math does not care about opinions. Let me show you what happened this week first, because it sets the stage for everything. Monday opened with absolute chaos. Crude oil pumped to nearly $120 a barrel. $120. Then it crashed back to $95 in the same session, a $25 swing in oil in a single day. Gold opened at $5,200, then got slammed down to $5,000. A $200 crash. Silver touched $85 on the opening, hit resistance, and got rejected straight down to $80 before clawing back to $84. Everything pumped, everything dumped, everything ended roughly where it started. And the reason is the same reason it has been for months now, the dollar. The dollar is too strong. Every single time gold and silver try to rally, the dollar surges on safe haven flows and caps the move. The dollar is the ceiling right now, and silver keeps hitting its head against that ceiling. But here's what you need to understand. Silver is not weak. Silver is being held back. There is a massive difference between those two statements. A weak asset falls when conditions are good. Silver is rising in the face of a historic dollar rally. That is not weakness. That is strength being suppressed. And suppression does not last forever. It never has. It never will. What I am about to show you in this video is the chart that tells you exactly where silver goes when that dollar headwind finally breaks. Because here's the thing. The dollar will not stay strong forever. It never does. History proves that. And when it turns, silver does not just catch up to where it should be. It overshoots. Violently. The gold to silver ratio chart that I am going to break down today tells you exactly how violent that overshoot is going to be. The numbers I'm about to show you sound extreme. I will be honest with you. I almost did not make this video because of how extreme these numbers sound. $150, $280, even $350. But the math is the math. And I'm going to show you every single step. I'm going to show you the inputs. I'm going to show you the calculation. I'm going to show you the historical precedent. And by the end, you are going to understand why these numbers are not fantasy. They are arithmetic. Before we dive in, I want to know something. What time is it right now where you are watching this video, and where are you watching from? Drop it in the comments. I want to see how far this video reaches. Are you watching at 2 a.m. because you cannot sleep thinking about silver? Are you watching on your lunch break? Are you in New York, London, Dubai, Mumbai, Tokyo? Tell me in the comments. I read every single one. And if you have ever asked yourself the question, how high can silver actually go? This is the video that answers that question. Not with opinions, not with hope, with math. Welcome to Finance Currency. If you are new here, this is the channel where we break down the hidden forces moving gold, silver, and the global monetary system. We do not do hype. We do not do clickbait. We do math, charts, data, and connections that nobody else is making. Hit that subscribe button right now. Turn on notifications, because what I am about to show you is the setup of a lifetime, and I do not want you to miss a single update. Also, quick question. I have been thinking about starting a WhatsApp channel where I share real-time market updates, breaking news on gold and silver, comex data alerts, and trade setups. Would you want that? If you want me to create a WhatsApp channel for Finance Currency, drop a comment saying WhatsApp. If I see enough interest, I will set it up this week. Now, let us get into the chart that changes everything. The gold to silver ratio. This is the single most important chart in precious metals right now. And almost nobody is talking about what it is actually telling us. The setup has been building for 15 years, and it just reached the inflection point. Stay with me. Do not skip ahead. Because if you miss the foundation, you will not understand why the numbers I show you later are inevitable. Let us go. Now let me show you something I've been studying for years, and the setup has never been this clean. Never. Not in 2011 when silver hit $49, not in 2020 during the crash, not at any point in the last 2 decades. The gold to silver ratio. Let me start with what it actually is, because this is the foundation of everything I am about to show you. The gold to silver ratio measures how many ounces of silver it takes to buy 1 ounce of gold. That is it, simple division. Gold price divided by silver price equals the ratio. Right now, the ratio sits at approximately 60.68. That means it takes about 61 ounces of silver to buy 1 single ounce of gold. Now, here's where it gets interesting. When the ratio goes down, it means silver is gaining value relative to gold. Silver is outperforming. When the ratio goes up, it means gold is outperforming silver. The ratio is not just a number, it is a compass. It tells you which metal is leading and which metal is lagging. And more importantly, it tells you when the lagging metal is about to catch up. Let me show you the chart. This is a weekly chart going back to 2011, and what you see is one of the clearest macro patterns in all of precious metals, maybe in all of commodities. In 2011, the ratio bottomed at around 32. Silver was outperforming gold massively. That was the peak of the last silver bull market. That was when silver hit $49 an ounce. The lowest ratio meant the highest silver relative performance. Then the ratio climbed for years as silver underperformed. Year after year, the ratio went up. Gold was outperforming silver consistently. The ratio peaked in 2020 at around 125 during the COVID crash. 125. That means at the worst point, it took 125 ounces of silver to buy 1 ounce of gold. Silver was being treated as almost worthless relative to gold. That was the peak of silver underperformance. Since that 2020 peak, the ratio has been in a structural downtrend. Lower highs, lower lows, a clear descending pattern, the trend changed. Silver started outperforming, and right now at 60.68, the ratio is sitting right on the descending trend line. It is pressing against it, testing it, about to break lower. Here's what I find absolutely fascinating about this chart, and I have not seen anyone else make this observation. Draw a trend line from the 2011 low through the major lows over the past 15 years. That is an ascending support line. It has held for 15 years. Silver has bounced off that line multiple times. Now draw another trend line from the 2020 high through the major highs since then. That is a descending resistance line. The ratio has been rejected from that line multiple times. These two massive multi-year trend lines are now converging. They are meeting at a single point. That point is roughly where we are right now, between 55 and 65 on the ratio. The chart is being squeezed between these two trend lines, like a coiled spring. The pressure is building, and when two 15-year trend lines squeeze price into a narrowing range, something has to give. This is called a wedge pattern. It is one of the most powerful patterns in technical analysis because it represents compressed energy. The longer the wedge builds, the more violent the breakout. This wedge has been building for 15 years. The ratio either breaks higher, meaning gold continues to outperform, or it breaks lower, meaning silver starts outperforming aggressively. And everything I see in the data tells me the ratio breaks lower, not slightly, dramatically. Here's why. The first target on the downside for the gold to silver ratio is 40. That is where the previous major support zone sits. The ratio bounced off the low 40s multiple times during the 2010 through 2012 period. That level has been tested and proven. 40 is the natural magnet. If the ratio breaks below 60 and accelerates lower, 40 is the first stop. That is not a guess. That is where the chart structure points. The second target is 25. That is the historic extreme. During the last major silver mania in 1980, when the Hunt brothers were squeezing silver, the ratio got below 20. In 2011, it hit 32. 25 sits right between those two historic extremes. And in a world where silver supply is in structural deficit, where comex vaults are draining globally, where the shorts are cutting their positions in half, the ratio compressing to 25 is not a fantasy. It is a mathematical probability based on the chart structure. Let me say that again because it is important. The chart structure, built over 15 years, points to ratio targets of 40 and then 25. These are not numbers I made up. These are the levels the chart itself is pointing to. Now, you might be thinking, okay, so the ratio goes to 40 or 25. What does that actually mean for silver price? This is where the magic happens. This is the part I told you to stay for. Let me do the math. Now let me do the math. And I want you to pay very close attention to this part because this is where everything comes together. I am going to show you 3 calculations. Each one is simple division, and each one produces a silver price target that sounds extreme until you understand the inputs. Ooh. My gold target over the coming months is $6,000 as the first major level. Why $6,000? Gold has been moving in 20% chunks during this bull market. That is the rhythm. That is the pattern. Every major leg up has been approximately 20%. And gold has hit that 20% target 5 or 6 times already during this bull run. The pattern has a perfect track record. 20% above the $5,000 area where gold is trading right now takes it above $6,000. That is the measured move. That is where the pattern points. Now, here is the first calculation. Gold at $6,000 divided by a ratio of 40 equals silver at $150 an ounce. Let me say that again slowly. $6,000 divided by 40 equals $150. That is 78% above where silver is sitting right now. And that is using the conservative first target on the ratio, $150 silver, just from gold hitting its measured move target and the ratio hitting its first support level. Not extreme inputs, not fantasy numbers, just the chart targets that the patterns are pointing to. Now the second calculation, my higher gold target is $7,000. If gold makes 2 consecutive 20% moves from here, it gets to the $7,000 area. That is not impossible. That is exactly what gold has been doing for the past 3 years, stacking 20% moves on top of each other. And if the ratio compresses to its second target of 25 during a full silver mania, which is what the chart structure suggests is coming, here is the math. Gold at $7,000 divided by a ratio of 25 equals silver at $280 an ounce. $280 at $84 today. That is a 233% move, more than tripling from here. And I want to be crystal clear, this is not a guess. This is not hope. This is simple division using 2 data points that both have strong technical and fundamental support. Gold at $7,000 is the measured move from the 20% chunk pattern. Ratio at 25 is a level that has been reached in every major silver bull market in history. Every single one. 1980, 2011. The ratio compressed to extreme lows. Neither number is extreme in isolation. Together they produce 280. Now the third calculation, and this is the one that kept me up at night, the one I almost did not include because I know how it sounds. If gold overshoots to $8,650 and the ratio compresses to 25, silver hits $350 an ounce. $8,150 divided by 25 equals 350. That is over 4x from current prices. Let me put these numbers in real terms so they actually land properly. If you are holding 100 ounces of silver right now, that is worth about $8,400 at today's price. At $150, that same 100 ounces is worth $15,000. At $280, that same 100 ounces is worth $28,000. At $350, that same 100 ounces is worth $35,000. Same metal, same ounces, just a different price because the ratio compressed and gold did what it has been doing consistently for years. Let me show you something else, the real-world example from this cycle. When gold made its move from about $4,200 to $5,600 earlier this year, a roughly 33% move, silver went from roughly $65 to $121. That is an 86% move. Silver moved 2.6 times more than gold on a percentage basis. And the ratio compressed from about 65 to 46 during that move. That is what ratio compression looks like in real time. That is not theory. That already happened this year. Now imagine that same dynamic playing out again, but from higher gold levels, with even more buying pressure from war-driven safe haven demand. And industrial supply shortages getting worse. The compression from 60 to 40 would be even faster than the last compression, because the conditions driving it are more extreme. And this is what separates people who understand the ratio from people who just watch the daily candle. The daily candle tells you silver moved 50 cents today. Noise. The ratio tells you silver is structurally set up to triple or quadruple from here, based on a pattern that has repeated in every precious metals bull market since the 1970s. The daily candle is noise. The ratio is signal. And right now, the signal is screaming. Now let me explain why the ratio compression happens in the first place. Because understanding the mechanics makes the math feel less theoretical and more inevitable. The ratio compresses for 2 reasons. 1, gold gets cheaper. That would push the ratio down even without silver moving. But gold is not getting cheaper. Gold is going up. So that reason is off the table. 2, silver gains more value relative to gold. Silver moves faster and farther than gold on a percentage basis, and that is exactly what happens in the late stages of every precious metals bull market. In the early stage, gold leads. Institutions buy gold first because it is the safe haven, it is the reserve asset. Central banks buy gold, not silver, so gold runs first. We have seen that. Gold has gone from roughly $2,000 to over $5,000 in this cycle. Silver has gone from around $20 to $121, both massive moves. But gold led. In the late stage, silver catches up and then overtakes gold. Retail piles in because silver is cheaper per ounce. Industrial demand compounds on top of investment demand. The narrative shifts from safety to opportunity. And silver's smaller market size means that the same dollar amount of buying pressure moves silver's price 2 or 3 times more than it moves gold. That amplification effect is what compresses the ratio. And once the ratio starts compressing, it tends to compress fast and far because the momentum becomes self-reinforcing. Silver outperforms, so more people buy silver, so silver outperforms more. $150, $280, $350. These are not guesses. These are the outputs of simple division using technically supported inputs. The math is the math. Now, let me show you the connection between the COMEX delivery data and the ratio, because this is the part that ties everything together. And I have not seen anyone else make this connection. COMEX silver deliveries just hit all-time records. The 12-month average is at roughly 43 million ounces per month, monthly spikes of 75 to 80 million ounces, the highest delivery demand in almost 20 years of data. At the same time, COMEX registered silver has plunged to 81 million ounces, and the open interest represents 294 million ounces of paper claims. Do the math on that. 294 million ounces of paper claims. 81 million ounces of deliverable metal. That is 3.6 ounces of paper for every 1 ounce of real deliverable silver. 3.6 to 1. Here is what nobody is connecting. The delivery surge is the mechanism that compresses the ratio, and I want to explain exactly how. When someone takes delivery of silver from the COMEX, they are removing physical metal from the system. That metal goes into private hands. It leaves the exchange. It is no longer available to be traded, leased, or used to suppress the paper price. Every ounce that leaves the COMEX through delivery is 1 less ounce available to the shorts to use as ammunition against the price. And the delivery data tells me that the ammunition is being drained at record speed. Now think about this in ratio terms. Gold deliveries are high, but gold's above-ground supply is massive because gold does not get consumed industrially. Almost every ounce of gold ever mined still exists. Gold is hoarded, gold is saved, gold sits in vaults. Silver is different. Silver gets consumed. It gets used in solar panels, electronics, medical devices, and military applications, and it does not come back. It is gone. So when you drain physical silver from the COMEX at record rates, in a market where industrial consumption is already creating a structural deficit, the available supply shrinks from both sides. Deliveries pulling metal out of the exchange system. Industry pulling metal out of the supply chain, both forces working together to reduce the amount of silver available for investment. And when investable silver supply shrinks while gold supply stays constant, the ratio compresses mathematically. There is less silver relative to gold. The ratio goes down. Silver reprices higher. This is why I keep saying the ratio compression from 60 to 40 and then to 25 is not just a chart pattern. It is being driven by physical reality. The COMEX delivery data is the engine. Every record delivery month accelerates the ratio compression because it removes physical silver from a system that is already running on fumes. And the people taking those deliveries know exactly what they are doing. JP Morgan took 3 million ounces in January alone. Bank of America has been stopping hundreds of millions in gold contracts. The smart money is pulling physical metal out of the paper system at a pace that tells you they expect the paper price and the physical price to diverge violently. And here's the part that I find most telling. The 4 largest short sellers have cut nearly half their positions since 2024. At the same time, the deliveries are at records. Those 2 data points together tell you a complete story. The shorts are closing because the physical metal is leaving the system. They can see the delivery numbers. They can see the registered inventory dropping. And they know that holding a short position in a market where the physical backing for that position is being drained by record deliveries is a losing trade. The deliveries are killing the shorts, not the price action, not the speculation. The physical metal leaving the building is what is forcing the shorts out. And as the shorts leave, the cap on silver weakens. And as the cap weakens, the ratio compresses. And as the ratio compresses, the math I showed you earlier starts playing out. $6,000 divided by 40 equals 150. $7,000 divided by 25 equals 280. $8,150 divided by 25 equals $350. The delivery data is the bridge between the COMEX fundamentals and the ratio math. Without the deliveries, the ratio is just a chart pattern. With the deliveries, it is a pattern being driven by physical force. And physical force does not reverse. Once metal leaves the COMEX, it does not come back. Every delivery is permanent. Every ounce removed is permanent. The pressure is cumulative, and it is accelerating. And the ratio chart is reflecting that pressure in real time. Now let me show you what the institutions are actually doing, because their behavior confirms everything I just showed you. Central banks bought more gold in 2024 than any year in recorded history, over 1 to 100 tons, and 2025 is on pace to break that record again. China, Russia, India, Turkey, Singapore, Poland, they are all buying. They are not buying because they think gold is overpriced. They are buying because they know what is coming. De-dollarization is not a theory anymore. It is happening in real time. And gold is the asset that central banks are using to replace dollar reserves. When central banks buy gold at record pace, it supports higher gold prices. And higher gold prices combined with ratio compression support exponentially higher silver prices. The institutional behavior is aligned with the chart pattern. The physical data is aligned with the ratio math. Everything is pointing in the same direction. $150, $208, $350. The convergence is happening right now. Now, before I move on, I want to pause and ask you something. Are you still with me? Drop a comment right now and tell me what time it is where you are. Are you watching this at midnight because you cannot stop thinking about what silver is about to do? Are you watching on your commute, at lunch? Tell me where you are watching from, what country, what city. I read every comment, and I want to see how far this message is spreading. Because the people who understand this ratio math are going to be positioned for one of the biggest wealth transfers in history. And the people who ignore it are going to watch it happen from the sidelines. Which one are you? Now let me bring this back to what is happening in the real world. Because the war just made everything I said more urgent. Iran struck a water desalination facility in Bahrain this week. 75% of Bahrain's drinking water comes from desalination. If Iran expands this targeting to the rest of the Gulf, the numbers are terrifying. Kuwait gets 90% of its water from desalination. Qatar gets nearly 100%. The UAE gets 90%. Saudi Arabia gets 70%. If desalination infrastructure gets hit across the region, we are not talking about an energy crisis anymore. We are talking about a water crisis, a humanitarian emergency affecting tens of millions of people in some of the wealthiest countries on earth. I have to be honest. This is the part of the analysis that keeps me up at night. We have been focused on oil prices and military strikes and silver vaults. But water is different. You can live without oil for a while. You can substitute energy sources. You cannot substitute water. And if the major Gulf states lose their desalination capacity, even temporarily, the humanitarian pressure to end this conflict becomes overwhelming. Or the conflict escalates to a level where water itself becomes a weapon of war. Either way, the uncertainty this creates in global markets is off the charts. From a gold and silver perspective, this is the kind of event that triggers what I call a flight to the absolute. Not a flight to safety, a flight to the most fundamental stores of value that humanity has ever known. When water supply is at risk, when energy infrastructure is burning, when the financial system is shaking from war and inflation simultaneously, the assets that have held value for 5,000 years become the only thing people trust. Gold and silver are those assets. They have survived every empire, every war, every financial crisis in human history, and they are about to prove their value again. From a market perspective, this kind of escalation is the catalyst that sends gold into the $6,000 and $7,000 range that my ratio calculations require. Energy war already pushed oil to $119 today before it crashed back. Water war pushes this into a completely different category of crisis, the kind that does not resolve in weeks, the kind that reshapes global alliances and forces emergency economic responses, the kind where gold becomes not just a good investment, but a necessity, and where silver follows gold but amplifies the move through ratio compression. And I want to point out something about the timing that I think most people are missing. The ratio was already compressing before the war started. It went from about 90 in 2023 to 60 now. That compression was being driven purely by fundamentals. Supply deficit, delivery demand, vault drains. The war did not create the ratio compression. The war is accelerating it. It is pouring gasoline on a fire that was already burning. And that is the most dangerous kind of move in any market. When a structural trend gets a macro catalyst on top of it, the move does not just continue, it explodes. That is what I think we are about to see in the gold to silver ratio. A structural compression that has been building for 3 years gets hit by a war that is targeting energy and water infrastructure across the richest region on Earth. The ratio is not going to gently drift to 40. It is going to crash there. and then keep going to 25. Now let me walk you through the path, because it is not going to be a straight line to $150 or $280. There will be resistance levels along the way, and I want you to know where they are so you do not panic when silver pauses. The first major resistance zone is $100 to $105. That is a psychological barrier and a technical one. Silver has never traded above $100 for any sustained period. When it gets there for the first time, profit taking will be intense. That is normal. Expect a pullback from that zone. It does not mean the move is over. It means the market is digesting a historic milestone. The second resistance zone is $110 to $115. That is where the previous rally stalled before making the push to the all-time high of $121. There will be sellers parked there from the last run. The market will need to absorb them. Once silver clears 115s and breaks the all-time high at $121, the psychology changes completely. There is no overhead resistance above an all-time high. No previous sellers to absorb. No bag holders waiting to get out at break even. It is open air. And in my experience, when a commodity breaks into open air after a multi-year base, the move that follows is not gradual. It is parabolic. I expect silver to shoot from the all-time high directly to the $140 to $150 zone where the ratio math first target sits. Consolidation there, then the next leg toward $280 as the ratio compresses to 25. That is the roadmap, $84 to $100. Pause, $100 to $115. Pause, $115s to $150. Larger pause, $150 to $280. And if gold overshoots $350 is not off the table. Now here is what I need from you. First, hit that subscribe button if you have not already. Finance Currency is the channel where we break down these patterns before they play out. Not after. I want you here for every update as this ratio compression unfolds. Second, drop a comment right now. Tell me your ratio target. Tell me if you think silver hits $150 before $280 or goes straight through. Tell me if the war changes the timeline. I want to hear your math. I will pin the best calculations. Third, tell me what time it is where you are watching this and what country or city you are in. I want to see how global this audience is, because silver is a global market, and I want to know who is paying attention. Fourth, and this is important, I have been thinking about creating a WhatsApp channel for Finance Currency, a place where I can share real-time market updates, breaking news on gold and silver, comex data alerts the moment they drop, war updates that affect the metals. If you want me to create that WhatsApp channel, drop a comment right now that says WhatsApp. If I see enough demand, I will create it this week and share the link in my next video. The people who are positioned for this move need real-time information, not delayed analysis, real-time. Let me know if you want it. Now, let me give you the bullet summary. Everything we covered in one concentrated hit. Gold to silver ratio at 60.68, descending from 2020, ascending from 2011. Two 15-year trend lines converging right now at the inflection point. First ratio target, 40. Gold at $6,000 divided by 40 equals silver at $150. Second ratio target, 25. Gold at $7,000 divided by 25 equals silver at $208. Overshoot target, $350. Comex registered silver at 81 million ounces. Open interest at 294 million ounces. 3.6 to 1 paper to metal ratio. Deliveries at all-time records. 43 million ounce monthly average. Shorts cutting positions in half. JP Morgan and Bank of America taking physical delivery at unprecedented pace. Central banks buying gold at record levels. Over 1,100 tons in 2024. Oil depots burning. Desalination plants targeted, water supply at risk across the Gulf. Silver's path, $84 to $100, pause, $100 to 115s, pause, break the all-time high, parabolic move to $150, then the real run to $280 begins. Silver's market cap is a rounding error in the global financial system, and the ratio math says this tiny market is about to reprice in a way that most people cannot imagine. But the math does not care about imagination. It only cares about division. And the division says $150, $280, $350. Do the math. Share this video with everyone you know who owns silver, who is thinking about silver, who needs to understand what is about to happen. The ratio math is something I have never seen anyone else break down this simply. 2 numbers, 1 division, and an answer that changes everything. Help me reach the people who need to see this before the ratio breaks. This is Finance Currency. and I will see you in the next one.